Welcome to another video of Financial Indicators by Fahad M. Gohar. This is going to be the video number 14. The subject of today, it would be very interesting subject to a lot of people, which is the current account to GDP. What it means, it provides actual insight into how a country is financing its domestic and whether it relies heavily on foreign capital. It gauges the country's economic health in terms of its international trade and investment position. It provides an insight into how a country is financing its domestic economy and whether it relies heavily on foreign capitals. So let's look at what it means. Are you an import country or an export country? This is very important, because a ratio that measures a country current account balances between export, everything you are exporting, minus imports of goods and services, plus of course the net earning from abroad and net transfer payment, relative of course to the gross domestic product. So this is very important. Are you an importer or are you an exporter? Of course we know that dependent companies, those are a company which a deficit might negatively impact them because they are reliant completely on imported goods and services, especially if the local currency depreciates, which make then the import for them more expensive. This can hurt, of course, profit, margin, and consequently the stock prices of those companies. So let's look at what does it mean deficit. It means a net borrower possibly relying on foreign investment to fund its growth. That will cause what? Will cause debt, a lot of debt on that country. Then we'll end up having to manage that debt, which means a country with a deficit might negotiate, of course, with the international lenders to favorable terms to finance their debt or seek assistance from international organizations like the IMF. But what does it mean, the surplus then? Surplus in the current account means a country is a net lender to the rest of the world. So that give it one step ahead in negotiating trade agreement. A country with a surplus might use its strong position to negotiate favorable terms agreement, while a deficit country might seek more balanced terms or assistance in improving its trade balance. So let's see how it is calculated, or what is involved in the calculation. It's very simple. Current account to GDP ratio is the current account balance divided by the GDP, which is the gross domestic product, multiplied by 100. What is the current account balance? Is the sum of export minus import, net income from abroad and net current transfer. So now let's look at how can a country and a decision maker use this current account to GDP. First they will use it to what? To monitor economic health, keeping an eye on trade balances and international competitiveness. Central bank usually may adjust interest rate based on the current account to control inflation and stabilize the economy. Large deficit will lead to currency depreciation. Conversely, a surplus might lead to appreciation pressure, pumping, of course, intervention to maintain competitiveness and to curb inflation. Also will attract investment. Countries with a strong surplus might attract foreign investment, viewing them, of course, as economically stable. Deficit country might focus on attracting foreign, direct investment, FDI, to finance their current account gaps. And lastly, policy adjustment. Government usually might implement policy to either boost export, to reduce import if the ratio is low, which is deficit, impose tariff, for example, to reduce imports, or to stimulate domestic demand if the ratio is high, like surplus, by providing incentive for export-oriented industry, promoting, the export. Now, let's see exactly the categorization of current account to GDP, because this will give us an idea how to visualize, how these things works, the current account to GDP. Of course, we have the levels here, which is the, around -4% or near the 0% or the 6%. Of course, when it is around the near zero, we call it moderate. Moderate means a ratio near zero suggests a balanced trade position, often considered, of course, healthy. Then if it is 6% and above, consider high ratio, positive, or we call it surplus, which means usually indicate strong export performance. However, remember, excessively high surplus above 6% of GDP may also signal an economy heavily reliant on foreign demand. Let's say the demand stops, then that country might really face big difficulty. So it has to divide between exporting and making the people within that country also use its own product, which could, of course, that if it happened will be risky if global condition change, wars, etc., etc. Then you have the low ratio, which is -4 and below, often seen in developing countries or those with high import relative to export. A deficit larger than 4%, of course, of GDP might raise concern about economic sustainability. Okay, now let's see what the trade surplus could affect. For example, in the stock market, of course, it will boost, the exporter stock, boost investor demand and confidence, so the stock market will go up. How about the interest rate? Of course, interest rate, will be reduced to stimulate, of course, domestic demand. So at this point, interest rate will go down. How about the bonds then? Of course, the bond will boost bond prices when you have trade surplus. How about the currency itself? The currency, of course, will be strengthened. The currency that could lead, of course, to deflation pressure if domestic demand is weak, making export, of course, more expensive, but import cheaper. So the currency value will go up. So now let's look at what the trade deficit could cause. So let's start first with the bond. What will happen to the bond? Of course, the bond here, when we have a trade deficit, the price of them will be lower, but the yield will be high. Why? Because when we have a deficit, the country will try to issue new bonds with a higher interest rate in order to attract some investment and some funds. So that will make the yield high, but the older bond will lose value or will lose attractiveness, and their prices will fall. So the price for the bond will fall. How about the interest rate? Of course, now when we have a trade deficit, we need to attract more money. So what we do, we raise the interest rate as the country needs to attract foreign cash, foreign capital, that will increase, of course, the borrowing cost for that country. So the interest rate here will go up. How about the stock? What will happen to it? Of course, as a company reliant on imported materials will decline, because remember what we said, you should not be reliant on just export. You have to rely also on the inside, and the user of your own country. So that will make the stock prices goes down. How about the currency? What will happen to it? Of course, a trade deficit will lead to currency depreciation. affecting import costs and the purchase power, and will cause inflation. So the currency will go down. How about spending? Of course, when you have trade deficit, spending increase on infrastructure to enhance the country export capacity and allow the economy to be greased up again and to move it forward. So this is a glance of the effect of the trade surplus and of course the trade deficit. And this is here a picture side by side for those aspects that are affected by the trade that you can visualize here. So now I'll give you just this small chart, to entertain yourself, the impact of current account on stock and bond. You can see the year by year stock market index, and you can see how the impact of current account on stocks and bonds. This is the bond, this is the stock. You can see as the stock goes up, bond goes down. And now also the current account balance versus GDP growth. Current account balance, as you can see here, the blue one, and the GDP growth. They almost, if they go up, as a pair. And I hope this was very helpful to understand the concept of current account to GDP, and you can use it in your own trade. See you in the next video. Goodbye.